If you have ever felt confused between order blocks, supply and demand, and support and resistance, you're not alone. They might look similar on a chart, but they are completely different tools, and mixing them up can cost you real money. In this video, I'll break down the differences between these three concepts, how smart money uses them, how traders get trapped, and how to choose the right tool at the right time. By the end, you'll see your charts in a whole new way. Here's what you'll learn today: what order blocks are and the exact criteria for spotting valid ones, what supply and demand zones are and how to filter for the best setups, what support and resistance levels are and the traits of the strongest zones, the difference between order blocks and supply and demand zones, the difference between supply and demand zones and support and resistance, how to know whether a level is an order block, a supply or demand zone, or simply a support or resistance level. Real chart examples showing the differences side by side for instant clarity. And before we dive in, don't forget to like this video, subscribe to the channel, and hit the notification bell so you never miss our latest trading lessons. So, get ready, let's dive in. Let's start with order blocks. In smart money concepts, an order block is simply the last candle that caused market inefficiency, the spot where big institutional traders likely made their decisions. Order blocks can form at the very beginning of a strong impulsive move or even in the middle of a move, sometimes as a candle in the same direction, other times in the opposite color. To confirm a valid order block, we use three simple rules. It must create inefficiency. Inefficiency happens when price moves sharply, leaving a gap between candle wicks. This shows an imbalance between buyers and sellers. It must break structure or show a change of character. This is our first clue that the market may continue in the same direction or reverse. It must be unmitigated. Order blocks only work once. We only trade the first time price taps back into that zone. Let's look at a real example of a valid bullish order block on the British pound US dollar 1-hour chart. Price made a strong impulsive move upward, leaving a visible gap between candle wicks. This imbalance, also called inefficiency, means smart money entered the market aggressively, pushing prices so fast that not all orders could be filled. This gap becomes a high probability zone where institutions may return to fill those leftover orders. That same impulsive move broke above a previous swing high. This break of structure confirms that buyers have taken control and are likely aiming for higher prices. Without this break, the move could simply be a short-term retracement. After the impulsive move, price has not yet retraced to the origin of the move, the last down candle before the breakout. This means the zone remains unmitigated. The fact that it's untouched increases the probability of a strong reaction, as institutional orders are likely still resting there. When all three of these conditions are present, inefficiency, break of structure, and unmitigated zone, we have a textbook example of a valid order block that we can trade with confidence. To understand the difference between an order block and a supply and demand zone, you first need to understand this ICT concept, the fair value gap. So, what exactly is a fair value gap? It's a price imbalance that forms when the market moves aggressively in one direction, so fast that it leaves an unfilled space between candle wicks. This gap shows an area where price didn't spend enough time, meaning not all buy or sell orders were filled. Because of that, it often acts like a magnet, pulling the price back for a retest. Smart traders use these gaps to pinpoint high probability entry zones, and when applied correctly, they can give you near sniper-level precision in your trades. How do you identify a fair value gap? Start by looking for a sequence of 3 consecutive candles. You're looking for a strong middle candle, one that clearly moves in a single direction, sandwiched between 2 smaller candles. Here's the key. If the high of the first candle and the low of the third candle do not overlap with the middle candle, a gap exists. That space between the first candle's high and the third candle's low is what we call the fair value gap. Once you spot it, draw a rectangle over that zone on your chart. That becomes your area of interest. This works in both directions. In a bullish setup, the gap forms as price pushes sharply upward. In a bearish setup, the gap appears when price drops rapidly. Just remember, if there's no gap between the first and third candles, it's not a valid fair value gap, no matter how big the middle candle is. Okay, now here's something important. A valid order block will always contain a fair value gap. No fair value gap? Then it's not a valid order block. The fair value gap is what confirms that smart money entered the market aggressively from that zone. Without it, the move doesn't have the same institutional footprint, and we simply don't consider it a true order block. Let's move on to supply and demand zones. A supply zone is an area on the chart where sellers step in with enough force to stop price from climbing higher. It often forms after a strong rally, when major players like banks and institutions start offloading their positions to lock in profits. This wave of selling pressure causes price to reverse and drop from that level. On the other hand, a demand zone is where buyers come in strong, stopping price from falling further. It usually appears after a sharp downward move, signaling that smart money is entering the market and driving price back up. Both supply and demand zones are key reaction points on the chart, and they can offer valuable clues for building high-probability trade setups. There are 4 key criteria for identifying a valid supply or demand zone. When institutions step in, they leave a footprint, and one of the clearest signs is the size and consistency of the candles. If you see large, clean candles moving strongly in the same direction, that's smart money at work. But if the candles are small, choppy, or filled with long wicks, that's just market noise and weak momentum. Those setups are better ignored. Only trade zones that haven't been touched before. The first test is usually the most explosive. Once price revisits a zone, its strength fades, and the odds of a clean bounce drop significantly. On lower timeframes like the 5-minute chart, you'll see plenty of zones, but this filter helps you avoid the stale ones. A strong zone often forms right after price breaks an important level, like a previous swing high or low. These breakouts aren't random. They're often moves designed to grab liquidity, trap retail traders, and shift market structure. When a zone forms after such a breakout, it's a strong sign that smart money is in control. Never trade a zone unless it offers at least a 3-to-1 reward to risk ratio. If your potential profit isn't at least 3 times your risk, the setup isn't worth it, no matter how clean it looks. Why? Because over time, poor risk to reward will kill your edge. Discipline is what separates consistent winners from the rest. So remember, big candles, fresh zones, a break of structure, and at least a 3-to-1 reward to risk. These 4 filters are your foundation for spotting only the highest quality supply and demand zones. Now it's time to put everything we've learned into action. Let's break down a real chart example and see if the demand zone in front of us meets all the criteria for a high probability setup, or if it's one we should avoid. First, the candles. Notice how we have large, powerful bullish candles driving in one clear direction with very few wicks. This is exactly the kind of price action that signals institutional buying. Big players don't sneak into the market, they enter with size, and these candles show it. Next, freshness. Has this zone been tested before? No, it's completely untouched. And as we've discussed, the first touch is usually the most explosive. Once a zone is retested, its strength fades, and the odds of a clean bounce drop. Now let's move on and look at the structure. Did price break a significant level? Absolutely. It pushed above a previous resistance and printed new highs. That's not random. That's smart money engineering a breakout, trapping late sellers, and grabbing liquidity. And finally, risk to reward. From this entry point, the setup offers a clean 4-to-1 ratio. For every unit you risk, you're aiming for 4 units of reward. Even if not every trade wins, this math keeps your edge profitable over the long term. So let's review. Strong, clean candles, fresh, untouched zone, break of key market structure, minimum 3-to-1 reward to risk ratio. This demand zone checks every box. It's not just a decent setup, it's a high probability trade that deserves serious attention. Alright, now let's break down the difference between supply and demand zones and order blocks. As we said earlier, a valid order block always contains a fair value gap, and it must be unmitigated. That fair value gap is the footprint of aggressive institutional activity, and the unmitigated nature means the orders inside it are still fresh. Here's an example. Take a look at this zone. Strong move, clear fair value gap, and price hasn't touched it since it formed. This is a textbook order block. Now compare that to a supply zone or demand zone. A supply zone doesn't necessarily have a fair value gap, and it can be mitigated, meaning price has already tapped into it before. That's a big difference. Let's make this interactive. Look at this chart. What do you think? Is this an order block or a demand zone? Notice the candles, the reaction, and the overall structure. If you guess demand zone, you're correct. Why? Because while it's a strong reaction area, it does not hold a fair value gap, so it cannot be classified as an order block. Alright, let's try another one. Look closely at this setup. Is this an order block or a supply zone? If you said order block, you nailed it. And here's why. It holds a clear fair value gap. Price has never returned to mitigate it, and it caused a significant break in market structure. That's everything we look for in a valid order block. So remember, order blocks must have a fair value gap and be unmitigated. Supply and demand zones may have a fair value gap, but it's not required, and they can be mitigated and still be valid. Knowing this difference helps you filter out low-quality setups and focus on the ones that truly give you an edge in the market. Now let's move to the third concept that most traders confuse with supply and demand zones and order blocks: support and resistance. So, what exactly are support and resistance levels? They're price areas where the market has previously shown a strong reaction, either rejecting the level or completely reversing direction. The key word here is potential. Just because price reacted there before doesn't mean it will again, but it can. And that's why these zones matter. Why do we mark them on our charts? Because when price returns to these levels, they often act as decision points, areas where liquidity builds, traps are set, and smart money steps in to make their move. If you've already marked these zones, you'll be one step ahead, ready to spot potential trade setups before the liquidity sweep even happens. But here's the thing, not every line you draw on your chart actually matters. Here's what to look for when marking high probability support and resistance levels. Clear swing highs and lows. Focus on the most recent extremes, the highest highs and lowest lows that clearly stand out on the chart. Multiple rejections. The more times price reacts to the same level and rejects it, the more likely other traders are watching it, and that means more liquidity sitting there. Obvious to the eye, a strong level should be easy to spot. If you have to force it or squint to see it, it's probably not worth trading. Obvious levels attract retail attention, and that's exactly where smart money hunts. Strong reaction or sharp move away. If price moved aggressively away from a level in the past, that's often a sign of institutional activity. These areas can act like magnets, pulling price back for a liquidity sweep. Role reversal. When a level has acted as both support and resistance at different times, it carries more weight. This flip often traps traders on the wrong side and leaves stop losses behind. Recent market respect. Prioritize levels that the market has respected recently. Old zones lose relevance as conditions change. You don't need all 6 criteria to mark a valid support or resistance zone, but the more boxes a level ticks, the more likely it is to become a key liquidity area. And that's exactly what smart money looks for. Alright, we've covered support and resistance. Now, what's the difference between support and resistance, supply and demand, and order blocks? Look at this chart. Here we have a clear supply zone. The move away is strong and it breaks through a previous level. This is not just a simple resistance line. It's a price area where institutional selling entered the market aggressively. Now, is it a valid order block? I'll give you 5 seconds to think about it. The answer is no, because it does not hold a fair value gap. Without that footprint of institutional imbalance, it doesn't qualify as an order block. Now, look at the chart above. You'll see a resistance level. Why is it considered a resistance level and not a supply zone? It's a resistance level because price was rejected twice, and it was recently respected. Why isn't it a supply zone? Because the move away from it isn't strong. The candles are small, which tells us it's not an institutional move. And why isn't it an order block? Because it's not unmitigated. The level has already been tested twice and there's no fair value gap. So I hope this makes it clear. You now understand the difference between supply and demand zones, support and resistance levels, and order blocks. Now let's look at another chart example. Here we have a clear support level, it's obvious, recently formed and recently respected. So why isn't it a demand zone? Because the move away from it is weak. The candles aren't large or decisive. Smart money isn't showing strong buying pressure here. That's why, instead of drawing a zone, we simply mark a line. And here's why that matters. Smart money often views an obvious support level like this as sell-side liquidity. They'll drive price below the line to trigger stop losses and trap traders, then reverse, a classic liquidity sweep. If you had mislabeled it as a demand zone, you would have drawn a big rectangle, watched price break through it, and assumed it was invalid, when in reality, the break was just a liquidity grab below support. The zone wasn't the setup, the sweep was. I hope this lesson helped you finally understand the difference between order blocks, supply and demand zones, and support and resistance. If you enjoyed the video and learned something new, make sure to like, subscribe, and hit the notification bell so you'll be the first to know when we release new trading videos. Thanks for watching, and I'll see you in the next one.